Well, happy Sunday to you, friends. Welcome to our video version of our Robinson Report for Sunday, August 15, 2021. Hope you're having a wonderful weekend. Let's begin with our disclaimer. Remember, you're always trading and investing at your own risk. I am not an investment advisor, but an individual trader and investor. My research tools and commentary are presented for your education and informational purposes only. You should always talk to a trusted financial advisor before you make any financial decisions. So today, August 15, 2021, is an historic day. That is, 50 years ago today, the United States dollar was taken off of the gold standard. That's right. President Richard M. Nixon interrupted the Bonanza show, of all things, and alerted the American people that the United States dollar was no longer convertible at the international level to gold. So the gold standard was finally abandoned, the final vestiges of it on this day 50 years ago. We have written extensively about this topic, not only in our book Bankruptcy of Our Nation, but you can also read our 4-part article series on the petrodollar system. If you've never read that, you can simply click on this image in the PDF or click on this link here. I really encourage you to read that or share that link with someone. It's available to be read without being a member. And it really helps explain where we are now, 50 years since that date. It's really hard to believe that it's been that long. So with that said, let's move right into today's current market trends. I want to take a look at several things here today. We have a lot to talk about. First of all, just looking at the matrix here to see what's going on. As you'll see, all major U.S. stock indices are locked in uptrends. The S&P, the NASDAQ 100, the Dow Jones. There's still quite a bit of softness in China, still a lot of volatility there. We've talked about what that is. We expect that we're probably near the bottom. We really have reached almost maximum pessimism, which is typically when you will reach that level of a bottom. Gold and silver still mired in those swing and position downtrends as we headed into the weekend. Still both clinging to their long-term uptrends, but that could break down if the United States dollar continues to rally, although it did pull back sharply on Friday due to a variety of things, and we'll talk about that in just a few minutes. Also, crude showing some near-term weakness, but still in that overall position and long-term uptrend, and Bitcoin, we called that new position uptrend last week in Bitcoin, and it had a great week this week. We'll talk about why as we head into the rest of today's report. So let's take a look at several charts here this morning. First of all, we have the S&P 500 index, as you can see, closing at that new record level on Friday. It rose about 0.7% last week, and the index remains locked in this historic uptrend. In fact, the S&P 500 index set its 48th record closing high this year on Friday, supported by another week of positive earnings reports and against a backdrop of mixed economic data. So the United States Consumer Sentiment Index, we'll talk about in just a few minutes, those figures were released on Friday, and they showed that Americans are feeling the heat from rising consumer prices and lingering weakness in the broader U.S. economy, these lingering COVID cases as well. And meanwhile, you have jobless claims that declined for the third consecutive week. That's encouraging bullish investors. And if you look over the pond, if you look across the Atlantic, you'll find out that European stocks have also been really strong. We've been tracking those in our global ETF model portfolio. You'll find that they have posted the longest winning streak since 1999. So European stocks just doing very well in this current environment. Still fairly weak U.S. Treasury yields are supporting this rally. The 10-year yield held steady throughout much of last week to close around 1.3%. on Friday. Then you also have this resurgent U.S. dollar, which eased somewhat during the week, but that's been providing also some relief for commodity and stock prices to see it pull back a little bit. When you look at value stocks, for example, in the month of August, we're seeing that value stocks have been outperforming growth stocks so far this year. Investors are turning defensive amid this rise in COVID cases in the U.S. and abroad, and there's also more concern surrounding that recent partial closure of one of China's largest cargo ports. That's also due to the rise in COVID cases in China. So we're watching quite a few things here, but overall the S&P remains in this massive uptrend. The S&P is now up 19% for the year. We continue to watch that 50-day moving average support, currently about 43.32, and then the 120-day support line right around 41.75. So we have another week of earnings ahead. It's a lighter week overall. In fact, last week was a really big earnings week. Positive earnings surprises continue to provide support for the overall stock markets here in the United States. So far, around 90% of S&P 500 firms have reported Q2 earnings, and about 88% of those have delivered positive earnings surprises. That's the highest level of earnings surprises in years. Now, as we look forward to this week, we have many big names going to be reporting. Lowe's, Home Depot, Walmart, Target. So a lot of big retail companies going to be reporting. You also have some chip stocks like NVIDIA, Applied Materials. You also have some Chinese stocks like Bilibili and Baozun and VIP Shops. Those are going to be reporting as well this week. And also Tencent Music, TME. And then you also have companies like John Deere and Foot Locker and Buckle, and Ross. So there's quite a few big names that are going to be reporting this week. And overall, we expect the market just to continue to do what it's been doing. We continue to see these big earnings surprises as we head through the earnings season. We're almost through it now as we head into this week. We probably have a few more weeks of earnings overall, but we're just about done. We're just about out of the woods here on the Q2 earnings. So I had mentioned the consumer sentiment numbers that came out last week, and as we look at the United States stock market as it just charges higher, we also have to note that U.S. consumer sentiment is plunging to a decade low here, as we learned last week for the first part of August. So this is a popular measure of how U.S. consumers are feeling about the economy. And the University of Michigan actually has been doing this for some time. This is a consumer sentiment index. And on Friday, we learned that this index fell to the lowest level in nearly a decade. Because U.S. consumers are just faced with all kinds of problems here. You have rising inflation on one side. You have this ongoing surge of new coronavirus cases that are concerning some investors and certainly concerning the medical community. Then you have this lingering weakness in the general economy, right? So it's kind of a double, triple whammy here for the consumer. It's a really tough time right now. And we look at the rising price of housing, look at the rising price of vehicles and consumer goods. That's left the average American, consumer suffering from sticker shock. And in some cases, you'd have to go back to the 1980s to find poorer readings on consumer sentiment. No doubt the U.S. economy is in uncharted waters here as we head forward. Take a look at the United States national debt. Right? We got rising prices, and then we have also rising debt. The U.S. national debt stands near $29 trillion. You got federal, state, local government deficits through the roof. You've got corporate and consumer debt levels sitting at near record highs. And then amid all of this, you have stock market prices just rising and rising. As I mentioned, the S&P 500 notching 48 record closes so far this year. You talk about strange days, but we are certainly here. And when you look at consumers, as I mentioned, they're getting crushed by rising prices at the grocery store, at the gas pump. Investors are reaping the gains of America's reckless fiscal and monetary policies. As I've long said, the Federal Reserve's primary goal is not to protect the consumer, but rather to insulate the investor class from experiencing anything resembling economic reality. If you've been following us for some time, this is what we've been saying for quite some time. This is what the Fed does. It's seeking to insulate the investor class from economic reality. And have they succeeded? They have succeeded wildly. So they're certainly accomplishing their goal. Now, the consumer is feeling the pain. The investor is enjoying the gain. And this is why we look at what we have today as really a K-shaped recovery, where you have, two different kinds of realities that are happening. When the stock market cratered back in March of 2020, Washington, D.C. threw historic amounts of freshly printed currency at the problem. They were hoping to stave off a once-in-a-century financial disaster. The result was a K-shaped recovery, where those who owned assets like stocks and real estate got wealthier amid rising prices, while everybody else got poorer. Now, whether you like it or not, the only way to get ahead in this debt-based economy is to own assets that will directly benefit from the Fed's reckless monetary policies. And that includes things like high-quality stocks and real estate, just to name a few. Proof of this has been on display and evident over the last few years. So the problem for policymakers as we go forward is that America's debt-based economy is more dependent upon consumers than it is upon investors. So they kind of have their priorities backwards, don't they? In fact, consumption composes nearly 70% or two-thirds of America's annual economic output, the GDP. So therefore, as goes the U.S. consumer, so goes the U.S. economy. American consumers are under pressure by historic debt loads and rising prices. And since the Fed's interest rate targets are practically at zero, this means that borrowing costs for the consumer, governments, and businesses can only rise from here. America's monetary and fiscal policymakers have themselves in a major bind. And what the ultimate outcome will be is anybody's guess, but if history can offer us any clues, it's not going to end well. So this is why we teach a very important strategy. The best defense is a good offense. And we have three basic steps we've been teaching for many, many years. Number one, a diversified pool of liquid savings. Some people disparage the need to have savings, and that's a very unfortunate thing. We teach the importance of having a liquid pool of savings. And we talk about, of course, we lay this out in our diversified 6-month liquid savings vehicle that we talk about. You can go to followthemoney.com/DSL to learn more about it. But we encourage 6 months of liquid savings at all times, not only as an emergency fund, but also as an opportunity pool of capital. The second step is a diversified investment portfolio, right? Some real estate, stocks, hard assets, even a few cryptocurrencies thrown in for good measure. So a nice diversified investment portfolio. And then thirdly, diversified income streams. And I can't pound the table on this enough, the importance to have multiple streams of income. And those actually compose our own strategy. This is how we approach the overall wealth creation process. We've been using this strategy for a long time. We teach it here at Follow the Money. So I strongly recommend the same strategy to all of our members and students. Let's turn now to a chart of gold. We'll see that we did call a new position downtrend on gold back on the 6th of August. And we see that gold has tried to rebound off of those lows we held at that 1675 area right in here, which we have been talking about. And right now, we look at what happened last week, about 0.8% rally last week. Here's the 1675 low that we hit, touched right there, bounced right off of it, pretty heavy volume, and then rallied back. Fairly low volume rally here. Nonetheless, the rally was largely sparked by a declining U.S. dollar. We'll look at that chart here in just a minute. So we got overhead resistance for gold. We've got this downtrending 50-day moving average, which is going to act as resistance, plus this down sloping 200-day moving average as well. So those are going to be areas to watch next week, 1807 to about 1817. That area is certainly an area to watch. We remain in a long-term uptrend, but as you can see, we're establishing lower highs along the way, and we're also achieving lower lows here and here, right? We kind of see this general downtrend or this bearish channel that's emerging. So watch out 1807 to 1817 for near-term overhead resistance. Now let's flip over to a chart of silver as well and take a look at this. It's pretty interesting where we closed the week at. We had a 23.75 kind of a bottom that was reached back in March before we rallied back. We reversed off of that, retook the 200-day moving average, then rallied right back up almost to about 29. As you can see up here, we've been moving in this $23 to $30 range for some time, kind of bouncing back and forth. And sure enough, we came down, broke that 30-day moving average, and then came down and then tried to hold the 200-day moving average for several weeks and then failed at that area. Came down, came up and touched the 30 and the 200, failed at that area as well, had a failed breakout above the 200-day there, and then came right down. And where did we go? We went below that former low, right, which was 23.75. We broke down below that area, and you'll notice we had a hard time right there, and we got stuck for several days. Now, you'll notice that the price of silver closed just above that area as we headed into the weekend. So this is going to be an interesting area here, but you'll notice the same thing here. Lower lows on this chart and lower highs, right, being set in this current environment. So kind of a bearish channel that's going on here as you look at the price of silver. Now, it remains in a long-term uptrend, but if we break down further and we lose this key area here of around 23, and notice that key area really held. We didn't have a close below 23 last week, although we went down intraday. This is a key area to watch. So watch 23 next week. And of course, there's plenty of overhead resistance as we head into the into the new week here. 2450 overhead, 25. Of course, this 30-day moving average will also be working as resistance as we head into the new week and beyond. So here's that chart of the dollar that I was talking about earlier. You have 93.50 resistance. We had a 200-day moving average breakout back in June, and the near-term U.S. dollar rally began to lose steam in the middle of the week last week. As you'll see, we came up to the same area we've been at for some time, hit right around 93, failed, 93 again, and failed. Pretty big sell-off on Friday, and that was largely due to new U.S. consumer price data that suggested that inflation may be peaking, which some traders believe could give the Fed more time to delay its inevitable tapering. So when we look at what traders are expecting right now, it appears that they're moving from an expectation of a September tapering announcement, that is next month, towards something more of a November or December tapering. And if that's the case, then that's going to provide some relief for gold and silver prices in the near term and could be bearish in the near term for the U.S. dollar. So the big next event that we're watching for is going to be the Fed's central banking conference that's held out in Jackson Hole, Wyoming, later this month. That's always very closely watched. So many will be watching for fresh clues from that meeting on the timing of the taper. So some people were expecting a September announcement. That seems to be getting scrubbed right now based upon some latest consumer price data. Maybe now a November or December date, but we're going to watch the Jackson Hole conference to find out if there's any clues coming out of that. So that's what we're watching here for the U.S. dollar. So let's turn next to our ETF model portfolio strategies. We only had one alert this week, and that was a downtrend alert, a position downtrend alert in these ETF portfolios, and that was on, as we'll look at in a minute, South Korea. South Korea entered a new position downtrend. But across the board, we're still seeing lots of strength in all of our portfolios. Let's just dive in and just take a look at a couple of things here. So in the PACE portfolio, the precious metals, agriculture, commodities, and energy ETF portfolio, lithium and rare earths are in the top two spots. That remains unchanged. We told you, watch lithium, watch rare earths. We've been talking about that in this report, and they've done really well. Water is up there as well. Agriculture also doing pretty well here. You'll notice in the top 7 here, we don't see any precious metals. We don't really see, we're barely seeing energy here. Crude oil has just recently fallen. DBO was leading our PACE ETF portfolio from a trend perspective in recent weeks, but we've seen some weakness there in oil. So lithium, rare earths, water, these are the hot areas right now as we head into the end of the summer and as we head into the fall. These are areas we're watching and are certainly strong. Again, turning to the global ETF model portfolio, we have that new position downtrend alert on South Korea. As you'll see here, we called the uptrend on South Korea back in June of 2020 at an alert price of $60. Since that time, the price of South Korea rose more than 60%, and it gave us a total max drawdown of around 10%. So that's not a bad return risk ratio. So again, we issued the uptrend alert back in June of 2020. It rose around 60% over that time since between then and now. And then we had a 10% max drawdown from the time that we had issued that uptrend alert. So that's now been basically been removed from the position uptrend model portfolio. When we look at the portfolio, we see that the strength is really in the United States and largely in Europe. We've been talking about the Netherlands being strong in recent weeks. Certainly, it's been a leader for some time. Also, the United States, S&P 500 leading the position portfolio from a trend strength perspective. Switzerland is certainly up there. Austria has been hot, as has been Sweden as well. And Ireland, by the way, jumping pretty nicely, jumped 4 spots last week, as did Argentina. Although Argentina is a lot more volatile than some of these markets, it's certainly doing well, rising about 53% since our uptrend alert. It's now ranked number 3 on our position trend leaders. Looking at the Trailblazer Tech ETF model portfolio, this is where we track many of the innovative technologies that are, expanding throughout the world through ETFs. And the NASDAQ 100, QQQ, leads our position uptrend portfolio. It's the number 1. It rose 2 spots last week. Also, the Exponential Tech ETF is leading our long-term portfolio. These are both very strong. Global Tech, IXN, Infotech, Vanguard, Infotech ETF, VGT also very strong here. So these are some of the leaders in that particular portfolio. Let's move on to some swing and position trading ideas for the week. This is just a little sample here. We have quite a few uptrends that you can check out. We only put a few in this report just so you can see. We rank them oftentimes by volume so you can just see which ones have the most volume. But again, you really want to drill down deep and click this link to find out what are all the swing uptrends, what are all the position uptrends. This is just a real quick sampling of what's in store. And when we look at the sector rankings for swing traders, right now we saw a big surge in consumer staples. That's why we actually have a consumer staples trading idea for Monday. But we saw a nice surge in that on the swing trend rankings. Utilities also showing some good strength, and basic materials also kind of reviving, jumping 3 spots last week. These are the 3 areas that swing traders might want to watch this week. It doesn't mean that none of the others will do well. Some of these might perk up next week, but these are the current leaders as we head into the new week. So if you have a stock that you're looking at and it's in the utility sector, the consumer staples sector, or the basic materials sector, it may outperform this week on a swing trade basis, so to speak. These are near-term trends. This is based on near-term trend strength. Looking at new position uptrends, you can see more here. Citigroup, Sonos, Norton LifeLock, Wendy's, Huntington Bank shares, several stocks forming new position uptrends, I believe around 97 the last time I checked. There may be a few less or maybe a few more, but that's quite a few new position uptrends that are going on. And there's several crypto-related stocks on the list this weekend, things like MARA, HUT, ETHE. So lots of things there to check out if you're into the blockchain space as well. And if you look at the sector rankings for position traders now, here's the hot areas for position traders. You have real estate, healthcare, and tech, right? These are the leaders right here, right now from a position trend ranking basis. We did see a perk up again in consumer staples. They rose in the rankings, as did basic materials. Look at energy, still sitting at the very bottom there. A lot of weakness still in the energy market. Now, let's conclude now with our cryptocurrency charts and comments. And don't forget, we recently did a video on crypto staking 101. This is such an important video. If you own cryptocurrencies and you're not currently staking them to earn income from them, especially if you don't even know what that means, if you're like, I don't even know what crypto staking is, well, you definitely want to watch this video. It's going to be worth your time. It's a really important video that we did. So we're currently staking several cryptocurrencies that we own, right? Ethereum being one of them. And in this video, we talk about how that works, how we do it, and how much we earn. We're earning up to around 14% from staking our cryptocurrencies. And then they never leave our hardware wallet in most cases. So they're right there on our Ledger Nano S, right? So they don't have to go on an exchange. They just stay right on our Ledger Nano S, but they're earning. So if you're keeping your cryptos on a hardware wallet, but you're not earning anything from those cryptos, you'll want to watch this video because we explain how you can do that just like we are. Okay, so let's start with a chart of Bitcoin here as we get into cryptocurrencies. Just do a quick update. So you see here that we called a new position uptrend on Bitcoin last week. Boy, we saw a nice rally since that time. So Bitcoin fully now in a position and long-term uptrend. It's been in a long-term uptrend for a long time, but the position uptrend came last week. So the crypto market, by the way, broadly retook the $2 trillion market cap last week. I think it's flirting with that area now as we make this recording, like maybe 1.9 trillion right now. But that's a key area. That's a key number. Also, there's been a lot of reasons why Bitcoin has been rallying. There's been a lot of things happening. So first of all, the IRS reported last week that they were going to ignore how the infrastructure bill defines a broker, right? So this is really big news for the crypto space. There were people who were worried about the taxation issues in the infrastructure bill, how it was kind of attacking cryptocurrency. And the IRS has weighed in on this and said, we're the ones who are going to actually be the ones who execute on this kind of information, and we're not going to do it the way that the bill might suggest. We're going to be more lenient. So that caused Bitcoin to rise. There was also a new survey put out that revealed that more than half of the top 100 banks are major investors in Bitcoin, digital assets, and blockchain technology-based firms. That was big. You also had Coinbase last week report earnings and just blew out. I mean, it was just a wow kind of earnings report. So Coinbase really surprising some people. Also, Invesco funds filed for a new Bitcoin ETF last week. It's going to be a futures-based contract ETF. It's not going to be a physical-backed ETF, unfortunately. The SEC has indicated that it's not open right now to a physical Bitcoin ETF. That is, that the ETF just holds physical Bitcoin. They're much more, and physical might be a funny word to use with these digital assets, but as opposed to a futures contract type of situation, that's what the SEC is open to. So you had a lot of refilings and new filings by companies that want to have a Bitcoin ETF. They want to be first in the market here in the United States. Invesco, now one of them, they're a really, really big outfit. They're the ones who run the QQQ, for example, ETF that I like to use for the NASDAQ 100. They're a pretty big outfit. Also, just kind of on a minor note, but AMC, that meme stock, the big movie theater chain, announced that it's going to be accepting Bitcoin later this year for movie tickets and at its concession. So you can walk in and pay for your ticket to a movie and buy your popcorn and a drink and candy with, Bitcoin. So that's also interesting. We're kind of seeing this move full steam ahead with Bitcoin adoption. As you can see here, Bitcoin up 58% for the year. It's well outside of that discount range. We never fell in that range since the pullback that began earlier this year. We're down about 26% from the $63,000 peak, give or take a few thousand there. And we're sitting at about $46,000. So Bitcoin really holding up well and responding the way that we had expected. We had told you that we expected to see a rally as we headed into the end of Q3 into Q4. And we expect to even see before the end of the year a new all-time high for Bitcoin. We still expect that. So things are beginning to move in that direction, and we're monitoring, of course, the markets as they do. Okay, next up is Ethereum. So Ether also really outperforming nicely here. We're in a position uptrend. We called that position uptrend again last weekend, and it's again really did well. As we headed into the new week, you see nice breakout above the 120-day moving average back at the beginning of August. Ethereum is the world's second largest cryptocurrency project, and it recently went through this really big upgrade known as the London hard fork. And we also had that EIP 1559 that began to burn Ether as a result of the transaction fees. So in other words, over the since that time, since August 5th, when this actually began, we've actually seen more than $140 million worth of Ether be burned since the revamp of that Ethereum fee system. So that is really big deal. I mean, that is a really big deal. So when you look at the number of Ethereum that are held on centralized exchanges, you'll see that they're hitting about a 3-year low. And the reason why that's significant is because when people are thinking about selling Ethereum, they'll move it out of cold storage and they'll put it onto an exchange. And then from there, they can trade it for something else, or they can, sell it, or whatever they want to do with it. But when they're not interested in selling it, well, smart, especially the bigger institutional investors will just take it off of the exchange and keep it safe in cold storage. So when you look at the number of Ether that are held on centralized exchanges right now, it's at a 3-year low. So out of the 117 million Ether in circulation right now, only 11 million were held on addresses related to a centralized exchange. That's pretty big. That's a pretty big deal. Only 9.4 of Ether is held on centralized exchange, and that's the least since 2018, as I mentioned, a 3-year low. The main reason is because Ethereum is so useful in the world of DeFi. So many people are locking up Ethereum for different DeFi purposes, as well as another 6.5 million Ether that are locked in 2.0 deposit, contracts. So, people are earning, that's what we're doing. So we're staking our Ethereum to earn, around 6% right now, give or take, per year. And so people are choosing to do that because there's, there's opportunity cost you'd be missing out on instead of just putting it on an exchange and just not earning anything from it. So Ethereum right now up 329% year to date, nowhere near its extreme value zone, well above that area. Never even entered it after the sell-off, just like Bitcoin. And as you can see, we're down about 24% from that 4,200 peak that was reached earlier in the year. All right, let's move on to Cardano, which had a really big week this week. And, it's been in a position in long-term uptrend now for quite some time. There was no new alert that we gave you. It was just remained in an uptrend. And we saw a nice bounce off of that 200-day moving average support line right there. You'll see we came down and then rallied big, then just took off. What's this volume? Why the excitement? Well, there's quite a bit happening right now in the Cardano project. And mainly, we saw, again, breakout above the $2 level here, right, for the first time since May. That's big. And this was the all-time high, $2.30 or so, give or take a few pennies. So we broke out above $2 now again, and now we're up here around $2.12 as of this recording. What's the deal? Why is Cardano running? Why are we seeing this? Well, the Cardano project is rolling out smart contract functionality. This is known as the Alonzo update, and that's coming out next month now. We heard from one of the project leads this week that the smart contract functionality will be rolled out live in September. In fact, I think the date is like September 12th, September 13th, somewhere in there. So this is going to allow Cardano to really enter into the DeFi space. It's going to allow the improvement for so many different things. It's going to attract many new developers to the space that are already chomping at the bit to use Cardano for smart contracts. And it's going to allow Cardano to further challenge Ethereum. So we've been long Cardano for many years, since 2017. We remain very bullish on the project, and we expect it to break out to a new all-time high before the end of the year, maybe even in the next few weeks, maybe even on the announcement of the Alonzo update. Again, that's coming next month, so big news for those of you who are long Cardano, like us. When you look at the returns on this thing, it has just been simply astonishing this year. We're talking about a 1,077% year-to-date gain. We're only down 8% from the previous peak, and we're nowhere near the discount range here. So Cardano really looking nice, up over 1,000% year-to-date. What a killer project this thing has been. All right, let's talk about two more charts here before we close out. So we got Chainlink. Now, we're calling a new position uptrend on Chainlink this week, so this is big news. Chainlink, is one of the 4 cryptocurrencies that we like for the long term. Last week, I told you that Chainlink was verging on a new position uptrend. Well, this week, we are confirming it. So we're issuing a new position uptrend alert on Chainlink. By the way, last week, part of the reason that we're seeing some strength here is that Chainlink announced that it has fully added decentralized weather data from Google Cloud. That's enormously huge. So remember, all the data that Google Cloud tends to generate would be centralized. So it's a big, hairy deal to have to make this decentralized data. And that's what's happened here. So Google Cloud and Chainlink have been collaborating since 2019. And now Chainlink has announced that it's offering decentralized weather data from the Google Cloud. And the reason why that's so important is because many of the smart contracts that power insurance related, of course, they need weather data. We've talked about that. Crop insurance, for example, they have to know, real weather data, and it can't be botched. It can't be, tainted. It has to be real good data. And so decentralized data is very important to be delivered to these smart contracts. And so Chainlink has made the move. Google, by the way, I guess they call themselves Alphabet. I always just still call them Google, but Google has been using Chainlink to develop their own blockchain applications now for quite a while on the Google Cloud. So if you believe that smart contracts are going to grow in popularity, then Chainlink is probably something that you want to take a look at, because as I've stated, this is the reason why we've been in Chainlink and been buying it since it was $1.96 way back at the beginning of 2020 when we first issued our buy alert to all of our members. We expect much more upside for Chainlink in the years ahead. Now, Chainlink was in the extreme value zone for some time. You may recall that. It was hanging out down here, right? It was hanging out right in here, and we were doubling up, tripling our dollar cost averaging, but it's no longer there. It's back out of that zone. So we're just right back to just doing normal dollar cost averaging. Up 136% year to date, still down about 50% from its $52 peak, but looking good as we head into the new week with a new position uptrend intact now on Chainlink. Lastly, I want to talk about VeChain. We talked about VeChain last week, and I told you again, it's verging on a new position uptrend, and now we are confirming that new position uptrend. So a new position uptrend on VeChain. This is one of the projects that we added this year. We added it in 2021. And so far, so good. It's a really compelling project we've talked about on our coaching calls. We'll have more to say about VeChain in the coming weeks. But what we do have to say is that it's no longer in that discount range this week. As you'll see, it has moved out of that area. So we were adding some right in here whenever it was deep in that zone, the 60 to 80% discount range. We were adding more to our dollar cost averaging. Now it's back out of that zone, so we would go back to a normal dollar cost average if we did. If we were dollar cost averaging 52%. Down though from its previous peak. And VeChain, by the way, announced recently that it's targeting the multi-billion-dollar pet food market in China. That's going to allow pet food manufacturers to use VeChain data, VeChain technology, which VeChain, if you're familiar with it, it's a supply chain management tool, and it's going to allow customers and manufacturers of pet food in China to confirm the proof of origin, proof of ingredients, and what they say the traceability of the entire value chain. So VeChain's already working with several companies in the Chinese pet food market. We've been aggressively long on VeChain for some time, and we expect that VeChain is going to continue to have more news like this coming out in the future. They've already been working on COVID information. They've been making a pretty big move in that space. They're finding different markets to really bring their very unique technology to, and there's so many different areas where they can disrupt. So we think there's a bright future ahead for the VeChain project. You can learn all about our cryptocurrency portfolio and get tons of educational resources on the cryptocurrency space. If you're new to it, we have got you covered. We've got a lot of great information. You got to be a gold or a platinum member to access all of that, and just click on that button to go right into that page and access all that good information. And with that said, that brings us to the end and the conclusion of this video update for our Robinson Report dated August 15, 2021. I hope you have a wonderful rest of your weekend, and we'll look forward to seeing you next time. Take care and God bless.